With the first half of the year done, certainly been an amazing year. We're up 10%. And, when you go back through history and you look at all these positive, greater than 10% first halves of the year, you start looking at how much can we get in the second half of the year. And when you go back through history, what we found, Brian, is that this market usually continues to keep pressing ahead. And in fact, you look back over the last, since 1928, you've had 26 other periods where you've had returns as strong in the first half, and you've had positive returns 77% of the time in the second half, with sort of an average return around 6.1, median return about 9.1. Brian, if this plays out this way, this is really a kind of a fat pitch right down the middle for our year-end price objective of 46.25 that we had recently raised over the last couple months.
What's the risk to all this, Craig, besides, stocks going down, the obvious? I mean, seems like the easy money has been made coming off the pandemic lows, literally and figuratively, the easy money from the Fed and the easy money in the markets. What are, if any, the major risks out there right now?
Yeah, I'd look at it this way. As we kind of navigated through the first half of the year, we had, certainly a few fastballs coming in with inflation. We certainly had a few change-ups in terms of market leadership in the first half of the year. And, last week you got a little bit of a curveball from the Fed, as it looked like a few of the dots had changed on the dot plot. And I think the risk going forward from here is the market. We kind of look at this, and we titled our most recent publication Full Count, because it kind of looks like to us that valuations are not necessarily cheap. You also look at the technical setup. It still looks strong at this point in time, and everybody's sort of waiting for the next pitch, and that next pitch very well could be the jobs numbers that we could be getting today. And if those jobs numbers come in hot, I think that you got a fastball, a swing and a miss, and you're going to see this market probably have a little bit of a correction. But if it continues to be a transitory setup in here, it's kind of high and outside, and you kind of see this market continue to walk its way toward first base and continue to work its way higher. And I think those are the kind of main risks out there. But then you go shift into Washington, and you got to think about, if we're going to get a series of tax increases, we're going to get perhaps changes in capital gains tax. Those are going to prove to be some, headwinds for the market as you look into the second half of the year, Brian.
Well, forget Goose Gossage with all those baseball analogies, and we'll have to call you Goose Johnson, I think, from here on out. So it sounds like higher rates are indeed the risk, but ironically, 10-year bond yields have been going down, not up, Craig.
And Brian, that's the curveball that is certainly, investors have been addressing last week. Doing calls after this publication has come out over the last day or so, there's a lot of people that were looking at those numbers coming out. Yeah, they're buying into the transitory argument at this point in time, but clearly we all know that wages will not be transitory. You can't give somebody a pay increase this week and take it back next week, kind of like what you see happening with commodity prices. Yeah. So from our perspective, this is going to be the key part to ultimately go through and watch, is where we're going to see happening with the jobs front. And again, from my perspective, I think there's a little more room for this market to continue to work into the second half. And from a sector perspective, Brian, I think you got to stay long the financials. I think you got to stay long the consumer cyclicals on the reopening trade. And also, I think you got to be there with the basic materials. And if I could have another sector to be overweight, we kind of restrict ourselves to 3. Energy has certainly been a top-performing sector that a lot of people have missed and ignored.
Best start to a year for the energy sector since its inception. It's up like 45% coming into this morning. Leave us with a name. You talked about financials. You've talked about it before, and you are staying long and strong. PNC.
Correct. PNC continues to look like a very constructive chart, breaking out the new highs on good relative strength. That's one to buy. And don't forget about Range Resources. Great long-term downtrend reversal, Brian.
Shepard Smith here. Thanks for watching CNBC on YouTube.